Tesla, TSLA, posted impressive gains last week and is up 17.3% in the last 5 trading days. That compares to just 3.78% for the S&P 500. The following options plays give different ways to play the stock depending on an investor's risk/reward preferences. The technical opinion rating for TSLA is a 72% with a strengthening short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. Rather than just buying the stock, investors can use the options market to find smart ways to trade Tesla stock with an attractive risk-to-reward ratio. Implied volatility is high at around 63%. The 12-month low for implied volatility is 36% and the 12-month high is 90%. The 4th percentile is 66%. Let's take a look at 2 option trade ideas using Barkart's option screeners. Option trade idea 1, buy a bull call spread. A bull call spread is created through buying a call and then selling a further out of the money call. Selling the further out of the money call reduces the cost of the trade but also limits the upside. A bull call spread is a risk-defined trade, so you always know the worst case scenario. Bull call spreads are positive delta, bullish, and positive vega, benefit from a rise in implied volatility. This trade involves buying the January 1140 call and selling the 1275 call. The trade cost would be $3,195, difference in the option prices multiplied by 100, and the maximum potential profit would be $10,305, difference in strike prices, multiplied by 100 less the premium paid. A bull call spread is a risk-defined strategy, so if TSLA stock closes below 1,140 on January 21st, the most the trade could lose is the $3,195 premium paid. Potential gains are also capped above 1,275, so no matter how high TSLA stock might go, the most the trade could profit is $10,305. In terms of trade management, if the spread dropped from $3,195 to $1,600, or if the stock dropped below 1,000, I would consider closing early for a loss. Let's take a look at another potential option strategy. Option trade idea 2, sell a bull put spread. A bull put spread is a defined risk option strategy that profits if the stock closes above the short strike at expiry. To execute a bull put spread, an investor would sell an out of the money put and then but a further out of the money put. This bull put spread trade involves selling the January expiry 1090 strike put and buying the 1060 strike put. Selling this spread results in a credit of around $13.65 or $1,365 per contract. That is also the maximum possible gain on the trade. The maximum potential loss can be calculated by taking the spread width, less the premium received and multiplying by 100. That give us 30 to 13.65 x 100 equals $1,635. If we take the maximum gain divided by the maximum loss, we see the trade has a return potential of 83.49%. The probability of the trade being successful is 54.5%, although this is just an estimate. The spread will achieve the maximum profit if TSLA closes above 1,090 on January 21st, in which case the entire spread would expire worthless, allowing the premium seller to keep the $1,365 option premium. The maximum loss will occur if TSLA closes below 1,060 on January 21st, which would see the premium seller lose $1,635 on the trade. The break-even point for the bull put spread is 1,076.35, which is calculated as 1,090 less the $13.65 option premium per contract. Mitigating risk. With any option trade, it's important to have a plan in place on how you will manage the trade if it moves against you. For a bull put spread, setting a stop loss of 25% of maximum risk is a good idea. In the case of the TSLA example above, that would be a loss of around $410. Traders that think TSLA is due to consolidate the recent gains and may trade sideways over the next few weeks could look at a long call butterfly trade.